So now we're going to turn towards what are some of the recent data points that have come out looking at prices received, prices paid, some of the disruptions that we've talked about. And one of the things that we've been talking about extensively is shrinkflation. So I've told the story before. I'll say it again. I'll try to do it briefly. So I had a marketing class where the teacher, we were working on when do people recognize the item is smaller? When does someone realize, hey, this Snickers doesn't weigh as much. This bag of Doritos feels like it has less chips. My Friendly's ice cream doesn't have as much stuff in it. And this is what you start to call shrinkflation. And he had essentially a fake Snickers bar from 1991, 2001, and then it was 91, 2000, 2001, and then for our class, which was in 05. And he laid out and he put out the three, and he was like, this is 1991, which looked like a king size bar. And the price was far less than what it was in general. And now you see them breaking them into two pieces. Everything that's being done is to shrink the total, grams or the unit price, the unit weight against the unit price. And this is what you call shrinkflation, where yes, to the consumer, the price is the same because you're still charging them $2.50. They're just getting less for their money. So when you look at the price adjustment, this is where you see the shrinkage, where now it's going to cost you more to buy the same amount you did previously. Now, for you, that may not be you could say, well, did I really need those extra 2 bites of a Snickers bar? Probably not. But for your family, when you're buying food, that is a problem because now instead of buying, in the past, you used to get you used to be able to buy a pound of pasta. Now it's not a pound. Now it's 3/4 of a pound. So you're buying 2 boxes and you're using 1.5. You're increasing the cost for the overarching family, not so much the underlying individual. Which is why when we talk about this, because let's be fair. When I was single and living by myself, I would make a pound of pasta, I'd eat some of it, I'd save the rest, and then I would eat it till it was gone. So if I wasn't going to, even though I could, because I do love pasta, I could eat a pound. I know I'm not supposed to, but so what does that mean for me? That means that instead of having dinner for 3 nights of a pound of pasta, I have it for 2. Not a huge deal, but when you're making dinner every night, that number adds up quickly, and that's when you start to see shrinkflation, and this is where we currently sit, and because this is only as of 2018, and for anybody who has been shopping in 2021, the items have gotten smaller again, and prices have actually just gone up, so that's where that pressure continues. Now, this is all happening while the World Trade Monitor Index. So trade continues to rise, but inventories and retail sales, this is what we were talking about, are still at record lows. You're still seeing this massive disconnect because we just can't catch up because there's so much tightness in the market. It's very difficult to actually try to just close the gap that has been formed over this extensive period. And you can see that the last time we saw anything like this was in 08 into 09. And just once it shifted down, you can see just how long it remained. And then obviously you had the asset light, at time deliveries. This is where we continue to see this problem, which is why those prices are gonna continue because the companies have no choice because they have no inventory. So they're going to be subject to whatever the market can bear on the supply chain. And this is just looking at it a little bit differently because when you look at truck tonnage, the truck side is essentially flatlined a bit because there's only so many trucks, there's only so many roads, there's only so much a truck can do, while the S&P 500 continues to just ignore a lot of it because at the trucking side as well, you've also seen a big increase in pricing, which is going to push, again, pricing onto more companies. And this is where we continue to see some of these friction points when we're looking to how is this going to impact margin for the companies, because you can't just pass through all of your price. It's going to be in lockstep, and it's going to happen over a period of time. But when we look at, just taking an example, the Shanghai Shipping Exchange Index, this is just showing you from just how expensive it is on the export side. This is well above 2020. This is just at record levels. And based on what we're hearing on the ground, what we're seeing at the ports, this is not going to stop. Now, it'll come down, but it's not going to normalize. It's just not going to be as bad, but you're still going to see a lot of this price getting pushed through the system. And that's why when we look at on a different level, the freight rates in general, this is just looking overall. Even after the Suez situation, you're still seeing increases. Asia to North Europe, Asia to Mediterranean, you're coming back to the highs because everybody's inventories remain so low, which is why you're going to continue to see these prices get pushed through because they have no buffer. There's no way to insulate that, which is when you turn to U.S. import prices and manufacturing industries. You can see that on a 1 month percent change, we keep seeing these manufacturing and import prices. All of these prices are trending up. Food manufacturing up 2.2%. And this is just 1 month change. I get the year over year. I get the base effect. I just want to know what is the trend right now, because March into April into May has not come down. So when you look and you say, oh, well, overall, well, transportation equipment, well, what about petroleum and products? So that's up 6%. When you look at furniture and related, 0.3%. When we're looking at just general movements, they're all moving higher. And that's why the trend is going to continue up, which is because this is just looking at manufacturing industry. So U.S. import prices and what is the manufacturing seeing? And this is going to get pushed down to the consumer. So this is what the manufacturer is seeing. It has yet to be recognized or at least pushed through, which is why they keep saying that they see prices going higher, because they're the ones that are going to set the price. They see their costs going up, and they're going to try to get some of that and recover some of it. Now, when we look at trust and how is this going to move forward over the next few years, because we're trying to export. We're trying to move companies. We're trying to shift flow from China into Vietnam, from Vietnam into India and Malaysia. Some of that from Malaysia into Pakistan. Like, who do we trust? And this, I think, gives you an indication of who are some of the countries that are trusted the most and least. And so, not surprising, China trusts Chinese companies, and American companies trust U.S. companies a bit less. So, but then they probably should. But you get an idea of where the trust is overall, and globally the shift. Where in China there is this propensity or this hesitancy to trust some of this global backdrop. They still trust India a fair amount, but when you look at Europe, you look at international companies, and you look at American companies, the credibility of China has come under pressure, which is why, even though China is trying to generate relationships, friendships, reaffirm agreements, there's this propensity to avoid or to put off. Like the EU has now stopped negotiations to ratify the trade deal because of the issues that remain abroad. And you can see that there is growing public support to do so, and especially against China, which is why I think this is a very interesting chart. Because when you're shifting supply chains, you could be increasing cost. You may incur cost, and all of these things are going to result in higher prices, because you're going to try to realize some of these costs that you've recognized, or you're going to have to eat them yourself, which is just going to hurt your overall margin and just general profitability. Because your revenues may be going up, but your costs are also going up. So again, you have to look at what is the underlying backdrop. And now this is the chart from Friday, where we looked at the PMI. So prices, PMI went through the roof. Purchasing Managers Index, or the PMI level for the composite, was 68.1. Driven a significant amount by services at 70.1, and manufacturing kind of holding steady at 61.5. but prices charged rose to 65.6 versus 62.2, highest reading since the series began, and 12th consecutive month of expansion. We're not seeing the slowdown. And you want to see the peak and then the actual pullback on PMI, because prices paid and prices received have a delay. So typically you see a rollover in prices paid, and then you'll see a stickiness where prices received will kind of stop going up or go up a little bit more, and then they'll start to top out. And we're just seeing a lot of this friction that's continuing because input prices rose versus the prior month to the highest reading since the series began. Now, this is just looking at PMI. This is not looking at anything else outside of this one specific factor. So then when we take this and spread it around, this is where we're going to start to see some of these pressure points. So, but how are people going to spend? Because we've seen a big increase in spending. We've seen a big increase in movements. But higher income areas have seen a larger decline in credit card balances. So we keep hearing that credit card balances are getting better, but higher income areas see the larger decline. So that means that lower income individuals are still seeing the pressure, are still seeing their credit, the amount of average credit card balances still remain elevated, which is just keeping this pressure on the underlying individual. And that's where we see this stickiness and these inherent shortfalls in consumer spending, and what will their appetite be to continue to spend. So declines in credit card balances are smallest for younger borrowers because they don't have the same type of savings, earnings. So they don't have the ability to pay down the credit card the way some of the older individuals. Not to say that that's meaningful or not meaningful for some of these spending patterns, but it just goes to show that, okay, well, who's freer to take a vacation? Is it someone who's 25 or someone who's 35 with a small kid? And not to say that both won't do it, but who has the freedom to do so without the strings attached, as those who are parents understand. So these types of nuances, again, lead to what could be a less robust consumer, especially as we see prices continuing to drive higher, keeping these credit card balances elevated. And then when you look at excess savings, you see this big surge and then fall because you have the government transfers stop. And the government transfers were some of the biggest drivers of this additional capacity coming through, this new movement coming in. And that's where you're starting to see some of this tailing. But it's also layered towards the top quartile. And again, so not everybody's experiencing it. All the while, some of the predictive patterns of where wages are going to go are off the jobs market. But when you look at some of the jobs numbers, and this is coming from the real-time population survey conducted by the Bank of Dallas, it's actually showing a decline of new jobs. So when we think about the jobs report, which has been positive the last few months, even though it's been well below estimates, it's still been strong in terms of the trend showing a recovery. It's actually coming in negative. Now it's done a good job of catching trend, but not so much the growth. And I think this is going to be concerning because, have we seen a pause in jobs hiring? And for those that have been longtime listeners or us or have been listening over the last couple of weeks, we've been saying that jobs were going to have this strong recovery and then really flatline. And I think this speaks to some of this delay. And we had that big increase in March because we had the reopening, you had restaurants, you had all of these things happening. You had seasonal hiring and just this big resurgence. And now you're starting to see that slow down and you're not seeing the same type because, again, the great reopening happened. That was March. March into April was the big move where, restaurants were open, bars were reopening, things were getting better, and you had that big hiring surge. And since then, you've had, companies went bankrupt and they're never going to open. And people are trying to do more with less employees, again, leaving some of this lackluster jobs. Now, with all of that being said, we've had another positive move in the totals Now, it'll get a little bit higher just based on where the trend was in early May, but it's not getting back to 17 million like we initially thought. Instead, it'll stay closer to 16 and a half, which is still a net positive. And then when you look at, well, how many states are ending emergency unemployment benefits, here's where you get an idea of where those benefits are going to stop. And the hope is that because it's scheduled, that you're going to start to see more people going in. But some of the friction points have been people not willing to pay higher wages. And that was a hesitancy. Now, getting rid of some of these extra benefits is going to cut down some of the the take home, which will then incentivize and push people to take a lower wage, but their costs are going up. So again, even though your wages may be going up slightly, your inflation on what you're spending is outpacing it exponentially. And this is an example of why. So when we look at U.S. manufacturing PMI, we have a lot of new orders. Backlog of work remains robust. And the problem is the new orders are going up, positive signal. But we have the backlog of work growing because there's not the inventory to just meet that, which is why we have growing unfilled orders. So at some point, you're going to have to pause taking these new orders because you're going to be saturated with this backlog of work. Now, you could say, well, hire more people, but it's not really the labor that's the problem. It's the actual raw materials and semi-finished goods that you don't have. And just based on timing, you're not going to have for a long period of time. And if it's something that you need right away, you're going to have to pay to airlift it. You're going to have to pay just crazy prices in order to see this coming through, which is why we see, again, these pricing pressures. So when we look at input prices on the U.S. manufacturing side, we're coming back to the highs from 2008 where, there's still more to go, but the pace has slowed down a little bit. But the output prices, when you look at just the differences, so the output prices are already outpacing what we were in 2008. So input prices are going up, output prices are also going up, and then prices charged have accelerated to all-time highs. Because input prices are going up, output prices are going up, that means that the prices charged are going to continue to trend higher as they try to gain some sort of metric to recover what we see. Now, in the U.S., it's been easier to pass through some of these prices, but it doesn't mean that it isn't being impacting the underlying consumer because they are starting to slow. Yes, they've gotten government transfers, but more of that is going into just meeting the growing prices throughout the economy. So when we look at, well, how quickly can we close this gap? Well, let's look at vendor lead time. Vendor lead time is at an all-time high by a wide margin because there's just not any movement in the system, which is why the backlog of orders is set to grow, which is why inventories will continue to get worse, even though we're already at staggering levels, which is why prices to the consumer are going to continue to push till the point that the consumer says, I can't take this anymore. And then you'll start to see some of that. But because of vendor lead times, because of the backlog of orders, the prices aren't going to stop going up. It's just the ability to pass them through will. And then that's when you start to get into a period of stagflation where you start playing with unit sizes and shrinkflation and trying to adjust something, and you get this stagnating capacity, which becomes a bigger problem. Then when you look at you following the same through, the prices paid versus prices received, prices paid at 10, almost 10, prices received at 5.5. Again, you're seeing how they're trying to kind of capture this back, and there's still more to get passed through. Now, looking at it from the availability, and this is going back to the job side, so the labor differential of jobs plentiful minus jobs hard to get. So the Richmond Fed of manufacturing availability of skills needed has gotten significantly worse, which just means that the jobs are there, but the skills aren't. And that's the underlying problem. How much of that has been replaced by robots or automation? And how much of it is just because people need to go get retrained because the job they got let go from, furloughed from, is not there anymore. And that's some of the biggest slack, because you have to go out and either the company has to train you, which means they're going to pay to train you. So they're going to give you a lower salary or lower benefits or benefit package and wages. But you're looking at this and saying, well, there's so many jobs available, I'm going to keep looking. And then the employer is like, well, there's a lot of people available, so I'm going to keep waiting. And you keep getting this weird bifurcation in the market. Now, all of this is happening as, again, the Philly Fed Business Outlook Survey, so the index came down to 31.5 versus an estimate of 41.5 in prior months. Prices paid surged to 76.8. New orders, employment, and 6-month outlook also fell. Notable that everything is still expanding, but off those highs. So the number of employees is declining. Again, these are these pressure points that we continue to see that are just giving us this pause and just think that we're really not at the end of this inflationary cycle higher because of this pass-through. So then when we look at manufacturing index, you get this gives you an idea of where we're coming back down to. We're still elevated, but just coming back down to the universe while new orders are starting to slow. Again, coming down to the unfilled side versus the new order side, which is why when we look at number of employees, that's coming down. And it's because people are working longer work weeks. So they're doing more hours. So people are doing more hours with less employees, again, trying to protect against some of that wages. Because if you see your cost already going up, can you really tolerate an additional employee or paying someone higher wages, because you have to try to pass that through and you're already passing through all of these other issues. And here's just another example of delivery times just getting worse and worse, and again, increasing some of that pressure that we continue to see. So then when we look at unfilled orders, similar thing. Like, none of this is different. We're just showing you from different areas of the Fed because they report on different locations, obviously outside of the aggregate. So unfilled orders, at a record, prices paid at a record, prices received at a record, but still not at the same level that prices paid were, as they continue to go up with unfilled orders remaining elevated. And all of this is happening as used car prices increase slightly off the low, but still 48% over year, and back to segment one, where we talked about the amount of shortages in the system is going to continue to keep this elevated on a year as well as a month-over-month level. And that's why when we shift to import prices, because you want to look at, well, what are import prices overall? You can see just the trend. It's still low, and there's still more to go as we continue to see the relative movements higher, just looking back through the supply chain. So this is showing that we've yet to even really see the type of growth that we could over the next few weeks, or I should say the next few months, especially when we look at those shortages at the port and the pressure that remains just throughout the underlying system. And that's why when we look at the Chicago Fed, just to wrap it up, the Chicago Fed National Activity Index in April was at 0.24 versus an estimate of 1.1, and was 1.71 in prior months. And there was less and less positive indicators, again, pulling this back down to earth, keeping some of these overhangs that remain in the system, putting more pressure on the consumer. But it's not the only piece as we now turn to the real estate market, and what are we seeing on the underlying housing boom.